Hi, today we are going to talk about currency derivatives. A derivative is something that derives its value from an underlying security. Most common type of derivatives are probably derivatives on stocks, and maybe you're hearing about currency derivatives for the first time. But they work and function very similar to stock derivatives. So if you know something about stock derivatives, you already know a lot about currency derivatives. So the first thing, or one of the most important things that you need to know about currency derivatives, or for that matter, any derivatives, is that investing in a derivative security is a zero-sum game. What do I mean by that? I mean that essentially the profit that somebody makes from investing in a derivative is essentially somebody else's loss. So if you were to add the profit and loss from a derivative transaction, it would sum up to zero. Now, that's not the case for the underlying security or investments in the underlying. So, for example, you read news about the value of Amazon stock going up, and it's saying that it's added billions to shareholder wealth. Now, those billions are not somebody else's loss. It's just value that the Amazon stock has created. Now, a similar example probably would be, let's say you were a currency investor, and you thought in the near future the euro is going to strengthen against the US dollar. Let's assume currently the USD euro trades at a parity. So for every US dollar you get 1 euro, and you had 1 million US dollars to invest. So assuming that you thought that the price of the euro is going to appreciate in the near future, you'd invest all your money, you'll convert all your US dollars into euros. Now, what that will do essentially is, now you have converted your 1 million US dollars into 1 million euros. Now, let's say your predictions turn out to be correct, and the euro appreciates to 1.2. So now for every euro, you get 1.2 US dollars. If you were to convert it back, for the 1 million euros that you own now, you would get 1.2 million US dollars, wherein you net $200,000 worth of profit. Now, this $200,000 is not somebody else's loss, right? This is just plain profit that nobody else has lost. But if you were to undergo or undertake a transaction in a currency derivative, whether it be forwards or futures or options, the profit that you make will essentially be somebody else's loss. So that's why derivatives are called a zero-sum game. So from an economic perspective, they don't add value. A lot of people would say that. However, I would like to differ from that standpoint. Even though they are a zero-sum game, uh, there is a lot of merit to derivatives, and that's why these securities are so popular. And one of the major uh, uh, one of the important functions that these derivatives serve is to be able to eliminate risk or to hedge risk. Now, for most events in our life, we have insurance, right? So whether be it health, life, auto, home, there's insurance that one can buy. However, for financial securities, where most of our wealth or most of an individual's wealth is locked, there are hardly any insurance products. And the reason is because financial securities are not standard, right? So it's very difficult for somebody to be able to provide insurance because they need similar repetitive large number of units for some risk to be insurable. So insurance companies don't essentially, uh, you know, create insurance products for investments. So investors then need to find some way of hedging, right? And currency derivatives provide that for forex traders. So to give an example of how derivatives work, first, before we go into options, let's talk about futures and forwards. Now, an easy way to think about futures and forwards is that essentially a future or a forward contract locks in the price for a future date. So to give an example how these can be used as a hedging tool, let's take an example of bread manufacturing. You know, so there is a producer, a farmer, or a large, a large farmer that produces wheat, and there is a bread manufacturer that uses that wheat as a raw product, as a raw material to make bread. Now, the farmer's risk essentially is that if prices of wheat fall, then he suffers, right? The bread manufacturer's risk is that if prices of wheat go up, then he loses. So essentially, the two can come together and enter into a forward contract or a future contract and essentially lock the future price of what wheat is going to be. So the farmer has no doubt about the price that he's going to receive when his crop is ready. Neither is the bread manufacturer going to suffer because he knows the price of wheat that he's going to buy at. So essentially, the forward contract in this case between the farmer and the bread manufacturer helps both of them out by mitigating that risk. So that's how a forward contract works. So in this example, uh, the forward contract will be that the bread manufacturer is going to say or agree that I'm going to purchase wheat from you at this particular price, and the farmer is going to agree to sell the same amount of wheat at that particular fixed amount of price to that manufacturer, thereby both of them locking in the rate, right? So in this example, the farmer is selling, right? So in financial lingo we'll call them when the farmer is going short and the bread manufacturer is going long, right? So if you think about their risks, and the terminologies, essentially the farmer is worried about prices falling down. So he needs to profit when prices go down. So he will be short on the contract, versus the bread manufacturer is worried that the prices might go up. So he needs to make money when prices actually go up from the contract, and that's why we say that he's going to be long on the contract. Now, the same example could, or a similar example could be thought about currency derivatives. Imagine that Boeing or Airbus is planning to sell a new airplane to Japanese airlines, right? Now, the quote could be in either US dollars or it could be in the local currency. Let's say that the quote is in local currency. So Japanese Airlines agrees to purchase an airplane from Airbus or Boeing for that matter. Let's assume Boeing. Boeing is going through a rough time right now, and let's say that they were able to sell one of their 370 Max planes, which are not nobody is going to buy these days. However, they managed to make that sale, and Japanese Airlines says that hey, we are going to buy it from you. Let's say that plane costs $100 million. I'm not sure about the price, but let's just go with that. And currently, for every US dollar, you get 100 Japanese yen. So 100 million times 100 Japanese yen. So the contract is for 10 billion Japanese yen, right? Now, if the price of the Japanese yen were to change, then the price that Boeing would receive is going to be different from the 100 million that they anticipate getting, right? And usually these contracts can be for 6 months or a year because Boeing has to actually manufacture the plane according to Japanese airline specifications, and that takes time. So between the contract getting signed and the actual delivery happening, there's usually 6 months to a year's time very frequently. So within that time, if the currency changes, then either Boeing could benefit or they could suffer, right? So essentially what Boeing is going to want to do is Boeing would want to enter into a forward contract wherein it locks in the exchange rate, right? So Boeing is going to go long uh, on the contract, and the manufacturer is going to go short. The key thing is that both of them can eliminate their risks by entering into such contracts. Now, forward contracts either trade at a premium or a discount, right? So the relationship is that there is if you compare the forward price to the current spot price, uh, if the forward price is higher than the spot price, then we say that the forward contract is trading at a premium. And if the forward price is lower than the spot price, then we say that the forward contract is trading at a discount. Now, whether a contract trades at a premium or a discount, especially for derivatives, will be a function of what are the interest rates going to be, right? So as we read in the future chapters, forward contracts are essentially a function of interest rates, and the interest rate differential is what is going to drive the value of a forward contract. It's going to be at a premium or a discount depending on what the interest rates or what the difference in the interest rates of the two countries between whom you are looking at the forward pricing is. So that's forward contracts, essentially simpler. So uh, by entering into a forward contract, you essentially lock in the future price. So let's say for the Japanese airline contract, uh, the current Japanese exchange rate is you get one for every US dollar you get 100 Japanese yen, and they expect that the future rate is going to be higher based on the interest rate differences. So they lock in at for every US dollar, the forward rate is going to be 110 Japanese yen, right? So that's the rate that they know eventually that they're going to get. Sorry. So that's forward contracts. Now, futures contracts are essentially very similar to forward contracts. The only difference being that futures are traded in stock exchanges, whereas forward contracts are typically over the counter, and the contract specifications are standard. The two parties that enter into a forward contract can decide on the terms, and they can negotiate the terms and enter into the contract accordingly. Future contracts, however, are traded through an exchange, so you have the benefit uh, of an exchange monitoring the contract. Now, either you trade forwards or futures. Typically, the underlying sizes of these contracts are very big, and you need to have significant amount of resources to be able to trade forwards and futures. Now, for most forward contracts, retail investors do not trade them, and it's usually between multinational corporations and large banks. So those are the forward contracts. However, the futures market is somewhat retail friendly, and you could trade forwards and you could trade futures on currencies on the exchanges. One of the common places to trade that would be the CME exchange. They have a bunch of futures, currency futures that one can trade. And I would implore you to visit their website and look at their products, and just understand the language in which currency futures are quoted. Even that is going to be extremely beneficial and a good learning opportunity. Now that was currency forwards and futures. Let's now talk about options. Uh, Options are slightly more complicated than forwards and futures, because with the option now the structure is not just two parties coming and mitigating each other's risk. In the option setup, you typically have a company which is similar to an insurance company, which essentially is selling a product and purchasing the risk and pricing it and charging a premium for that. So in an options contract, typically there are three parties involved. One is the purchaser of the option, uh, and of course there could also be a seller of the option, and then there is the writer of the option. The writer is essentially the person who is collecting the premium. Uh, so before jumping so many steps forward, let's break down what an option is. An option is essentially the right uh, to buy or sell, depending on whether it's a call option or a put option, a specific underlying security at a specified amount of time for a specified price known as the strike price. So it gives you the option to purchase or sell an underlying security at a given time for a given price. Now, because it is the right that is being purchased, the purchaser of the option can or cannot exercise that right, depending on whether it's profitable for her or not, right? So the person who is writing the option collects the premium upfront and says that, hey, I agree to sell you this particular underlying security for this price on this date, and you have the option, you have the choice to purchase or sell that underlying security at that day or not, depending on whether you want to do it or not. Uh, So there are three things that are key in understanding the pricing of this premium, right? Uh, First is how much in the money or out of the money a particular option is. Now, what do I mean by in the money or out of the money? An option is said to be in the money if the strike price is greater than the spot price. So, sorry, let me qualify that. A call option, an option that gives you the right to purchase the underlying security for a specific price, the strike price, is said to be in the money if uh, if the spot price is greater than the strike price. So, for example, let's say you purchase an option. Again, let's go back to the euro example that we have, and the strike price is the current exchange rate is let's say it's trading at 1, right? And the strike price is 1.2, right? Now, so you are choosing to buy something assuming that eventually the price is going to go up to 1.2. The option gives you the right to purchase something that's currently priced at $1 to buy for $1.2. Are you going to pay more money or less money for that? Of course, you're going to pay less money for that, right? Because uh, the spot rate is less than the strike price. Now, assume the reverse, right? So let's say there was another option which was giving you the right to purchase the same euro but at a lower rate. So let's say it was giving you the right to purchase euros for zero point 0.8 in the future, right? Currently it trades at 1. So already this contract has some moneyness, right? So you have the right to purchase something that's currently trading for 1 at a rate of zero point 0.8 in the future. So if the rates were to remain the same and not change as much, then you would already be making money, right? So this option already is in the money versus in the previous example, it was out of the money, right? Now the third thing could be at the money. So suppose somebody is selling you the option of buying euros 6 months down the line at the same price as the current spot rate, which is 1. So this option is called at the money, right? Because it's trading at the current spot price. Now, if an option is in the money, then the premium that you pay for that is going to be higher versus for an option that's out of the money, then the premium that you're going to pay is going to be lower. So this is one of the most important things that determines the premium. The second thing is the underlying volatility, right? Now, typically, if you look at the Black-Scholes formula, and we won't go into the math of all of it, but one of the key factors that is used to price an option is the underlying volatility. If a stock is more volatile, then essentially whenever you're buying protection on a more volatile asset, then the premium that you're going to pay is going to be higher, right? So think of it this way, right? If there is a person who has a bad driving record, if he or she goes to purchase insurance, the car insurance company is going to charge him or her a higher premium because essentially their driving history is bad. Similarly, in options, if the underlying volatility is high of the underlying security, then the price or the premium that you pay for that option is going to be higher. So that's the second thing. The third thing is how much is the time to expiration. So if an option expires in a week's time versus another option that expires in a month, the option that expires in a month is going to have a higher premium. And again, the reason is that you're buying protection for a longer period of time, right? So think of it as buying an auto policy for 1 month versus buying an auto insurance policy for a year. The amount of premium that you're going to pay for the year is going to be higher. So same about options, right? So that's essentially the gist of currency derivatives. And I'll read your discussions, and if I feel that you all are still not understanding currency derivatives, I'll try and come up, produce some more videos to help, clarify some of the questions or difficulties that you're having. But I hope that this gives you a flavor of what currency derivatives are or what derivatives are in general. And again, if you still have questions, please feel free to reach out to me, and I'll be happy to help you with any doubts that you have. Thank you.